But it was a command.
Check. Shout out to everybody here. Let's get ready for this Fed meeting. 6 minutes till Jerome Powell opens his mouth. We're going to take a look at what's happening. Already Bitcoin getting a bit of an edge here, popping up to 30,000, almost 400, but then getting rejected. We just went to 29,438, but would come back down immediately to the downside. Let's get excited. Let's get it going. Are you excited? I'm excited. We're going to only get some music for a little while, so we only get to jam, and then we have to listen to Jer Powell for like an hour. But you know what? It's still going to be fun. I actually really have a good time every time. I know all the people, Kobe Smith, right? All the different people that are going to ask their questions today. We know it's like the same 12 journalists. You'd think there'd be a different one every once in a while. Seems kind of rigged a little bit, but you never know. Something different about my outfit right now that there wasn't there today. We're going to ask in a little while. Anyway, do something fun for the group, for people that came back for the double stream. We love you and we appreciate you. So let's take a look at BOOKMAP. It's been heating up. More liquidity has kind of got into 29,800. It's gotten deeper red and it's got a little more bar. It's got a little more zonage to it, telling us it's more likely we do head up to that area. We're starting to brew. I've seen this many times. And again, maybe we dump to the downside. It's a volatile day. I'm not attempting to trade this, but there's a move up here, likely because we're so close to this bar of liquidity. Whenever I've seen the balls this close to this bar, it's likely we hit the bar. I'm not saying it's guaranteed to happen, but it's very likely. This is BOOKMAP. Link in the description below to BOOKMAP. Help you out on a Fed day. Show you what's happening. See what's behind the candles. Zoom in here, and I can actually see the fractals. Start to see what's going on. Are we making a flag? Are we making a falling wedge? What's happening inside the charts? I've even seen inverted head and shoulders inside of here. Same idea, but it's, show me what's inside these candles. I want to see the order book. Let's go, baby. Let's go. All right. Shout out to all man TX Crypto. You're a smart man. You're a smart man. Spot on. A very perceptive individual. I want to have you on the team. Are you all right? Are you serious? Okay. She might be in the closet, babe. She was just right next to me. Babe, don't do this to me. Oh my God. Why are you doing this, man? So paranoid, man. Jesus. Does your wife do that to you too? You get all nervy, man. What's up with that? You know what I mean? Jesus. Give me a heart attack. Like I was about to literally end the show and go like, look, can I watch your job? You do whatever makes you happy. Well, let's get ready to rumble here. I got it ready. I got it ready right here. There it is. Oh my gosh. Oh my gosh. The Fed meeting coming at you at top speed. I'm looking at this MX token. I'm tight. I'm in this for heavy money. I'll be honest. I'm in this pretty heavily, but we'll see what happens. I may take a beating. I may take a win. You never know. I'm open-minded to let you in on what I'm doing though. You'd be privy to the infos. So let's get into a sweet spot here for Bitcoin. Broke out, broke back down. Just keeps hitting the trend line. I feel like it broke out and it's retesting. You see that? Retesting that zone. Huge wick to the upside. Already crazy volatility, right? Already crazy volatility. But right now it has launched its way out of this move to the upside. I even see this kind of forming here, just to kind of, a little bit of an ascending triangle there. So, yes. Move that down a little bit, 29.6. So let's zoom in now and get ready for the meeting. Wow. Shoulder, head, and a shoulder. I mean, this is ugly. Look at that price action. just going after whoever and whomever wants to play games, right? I'm attempting to make some type of sauce out of it, but there's like not a lot of sauce to be made. Wow, that is messy. And I hope he is so dovish it's ridiculous. So we'll watch this falling wedge in the 30-second. Technically should break to the upside. After it gets rejected, it comes down to the bottom of the channel. We'll see. But we'll keep this on ice. This will be our Jer Powell shot that I'll have on the right side of the screen. You gotta come prepared. But that's the 30-second. All right. So this will be over here. I shrink down a little bit. You know how this works. I shrink down. Sorry. What if my voice got really low? Dude, why did you have to do that, Jason? You're such a guy, man. I love you, bro. Shout out to you, man. Thank you so much, man. Back at it. Comes through and blesses me. Number one, tells everyone my channel is amazing today on his live stream. Then comes and gives me a $99 super chat. Dude, one of the nicest people you ever meet, Jason Casper, man. Shout out to Jason. And the other day you said every time I dress nice, I make you look like you dress horrible. But you got the diesel pecs, man, and you got like the big traps, man. I think it just goes. I dress nice. You know why I dress nice? Number one, because crypto's like comic books, right? And we need all the characters. You know, we got the guys that wear like the hoodies and the cool dudes. We got the muscle man like you, right? Or it's like wrestling. You know what I mean? Like I'm $1 million man, you know what I mean? And then you gotta have the guy that just looks cool and dresses nice every time, you know what I mean? So I gotta keep up that, like, I'm just one of the icons in the game. Just so we all don't look alike, you know what I mean? There's and we all have to have that mix, you know? So, all right, let's bring down the music. Let's be quiet and let's listen to the man, the myth, the non-legend, Jer Powell.
Slowed from earlier in the year. Although activity in the housing sector has picked up somewhat, it remains well below levels of a year ago, largely reflecting higher mortgage rates. And higher interest rates and slower output growth also appear to be weighing on business fixed investment. The labor market remains very tight.
So far a pump right now.
Over the past 3 months, job gains averaged 244,000 jobs per month.
Bit of a W.
A pace below that seen earlier in the year, but still a strong pace. The unemployment rate remains low at 3.6%. There are some continuing signs that supply and demand in the labor market are coming into better balance. The labor force participation rate has moved up since last year, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. While the jobs to workers gap has narrowed, labor demand still substantially exceeds the supply of available workers. Inflation remains well above our longer run goal of 2%. Over the 12 months ending in May, total PCE prices rose 3.8%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. In June, the 12-month change in the Consumer Price Index, or CPI, came in at 3.0%, and the change in the core CPI was 4.8%.
We know that.
Inflation has moderated somewhat since the middle of last year. Nonetheless, the process of getting inflation back down to 2% has a long way to go. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher cost of essentials like food, housing, and transportation. We're highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning to inflation to our 2% objective.
You're never going to get to 2%. Nice haircut.
At today's meeting, the committee raised the target range for the federal funds rate by a 1/4 percentage point.
He will never get to 2%.
Bringing the target range to 5.25% to 5.5%. We're also continuing the process
Here it
of
comes.
significantly
Here it comes.
reducing our securities holdings.
He's dumping on the market.
With today's action,
Why
we've
were they
raised
holding
our
securities in the
policy
first
rate
place?
by 5.25 percentage points since early last year. We have been seeing the effects of our policy tightening on demand in the most interest rate sensitive sectors of the economy, particularly housing and investment. It will take time, however, for the full effects of our ongoing monetary restraint to be realized, especially on inflation. In addition, the economy is facing
I love this
headwinds
guy.
from tighter credit
It's your
conditions
pal.
for households and businesses,
so funny.
which are likely to weigh on economic activity, hiring, and inflation. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks. We remain committed to bringing inflation back to our 2% goal and to keeping longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run.
Inverted head and shoulder, shoulder.
To conclude,
head, right
we
shoulder.
understand that our
That should
actions
break out.
affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to
Measured
achieve
move
our maximum
29387.
employment and price stability goals. Thank you, and I look forward to your questions.
That's all he said? Oh, my God. They are
Mr.
mailing this
Chairman,
one
thank you. You have, I think, a couple times in your opening remarks, talked about this language in determining the extent of additional policy firming that may be appropriate. Should we take that to mean that additional hikes are likely on the
here
way?
we go. Here we go.
And should we also
Here we go.
believe that
Here we go.
all future meetings, say September and November, are live, or are you in a every other meeting mode? Thank you.
So we haven't made a decision to go to every other meeting. It's not something we've looked at. We're going to be going meeting by meeting.
Look at that
and,
chicken head.
as we go into each meeting, we're
So-
going to be asking ourselves the same question.
I'll have
So
it when
we
I
haven't
do.
made any decisions about any future meetings, including the pace at which we'd consider hiking. But we're going to be assessing the need for further tightening that may be appropriate. You read the language, to return inflation to 2% over time. I would say that the intermeeting data came in broadly in line with expectations. Economic activity remained resilient. Job creation remained strong while cooling a bit. And the June CPI report actually came in a bit better than expectations for a change. And the June CPI report, of course, was welcome, but it's only one report, 1 month's data.
Thank you so much.
We
Jump
hope
on
that
in, baby.
inflation will follow a lower path but it will be consistent with the CPI reading, but we don't know that, and we're just going to need to see more data. So what are we going to be looking at? Really, it will be the whole broader picture, and starting with we're looking for moderate growth, right? We're looking for supply and demand
Look how that
through
inverted
the
head and
economy
shoulder just
coming
played
into
out.
better balance.
Look at that.
Including in particular in the labor market. We'll be looking at inflation. We'll be asking ourselves,
Would you look at that?
does this whole collection of data, do we assess it as suggesting that we need to raise rates further? And if we make that conclusion, then we will go ahead and raise rates. So that's how we're thinking about the next meeting, and how we're thinking
Shoulder,
about
head,
meetings going
shoulder,
forward
neckline.
potentially. But we're now mainly thinking about the next meeting. I will also say, since we're talking about it, between now and the September meeting, we get 2 more job reports, 2 more
777s.
CPI reports. I think we have an ECI report coming later this week, which is Employment Compensation Index, and lots of data on economic activity. All of that information is going to inform our decision as we go into that meeting. I would say it is certainly possible that we would raise funds again at the September meeting if the data warranted, and I would also say it's possible that we would choose to hold steady at that meeting. We're going to be making careful assessments, as I said, meeting by
That's so
meeting.
bullish that they said they're going to hold steady. Look
And
at
I'll close by
We're
saying
about to hit
we've
my
raised the
target of
federal
the
funds
inverted
rate
head
now
and
by
shoulder.
525
Nailed it
basis
right there.
points
Look at
since
that.
March 2022. Monetary policy, we believe, is restrictive.
That's why people like coming to my channel. Look, I just showed you the inverted, the shoulder, the head and the right shoulder played to the upside. You could have played that on futures. 10x leverage would have made gains right now. And then I watched the shorts get squeezed up to 49. So you wouldn't have been one of the few people that got liquidated right now. You would have been playing this inverted head and shoulder to the upside.
I'm just going to go back to what I said. That's the question. We have 8 weeks now until the September meeting, and all that data that I recited, we're going to be looking at all that and making that assessment then. And it really, we did have the one good reading, and of course we welcome that, but it's just one reading, as everybody knows. And we've seen this before in the data. Many forecasts call for rates for inflation to remain low, but we just don't know that until we see the data. So we'll be focusing on that.
Wow, he's vague today. He doesn't want to say anything.
Thank you. Thanks for taking our questions,
Nailed
Chair
it.
Powell. Obviously, you upgraded the language around growth in the statement today. We've seen the Barbie movie numbers. We've seen everyone going to Taylor Swift concerts this summer. It seems like the American consumer is in pretty good shape. And it does seem like growth is sort of picking back up a little bit, or at least doing well. And I wonder, from your perspective, if that continues, if we see growth not just stabilizing, but doing,
Barbie.
Performing well
She
this
went to
summer,
Barbie.
is that a problem
that's rude.
because
Maybe she
it's
did. Who knows?
inflationary, or is it good news because it suggests that a soft landing is more likely? Just how are you thinking about that sort of trajectory?
Yeah, so I would say it this way. The overall resilience of the economy, the fact that we've been able to achieve disinflation so far without any meaningful negative impact on the labor market, the strength of the economy, overall, that's a good thing. It's good to see that, of course. It's also, you see consumer confidence coming up and things like that. That will support activity
Short squeezing
going forward.
again.
But you're right, though. At the margin, stronger growth could lead over time to higher inflation, and that would require an appropriate response from monetary policy. So we'll be watching that carefully and seeing how it evolves over time.
You just hit that take profit inverted, though.
Thanks, Chair Powell. Neil
1,
Irwin
2,
from
3.
Axios.
Bang.
So as you referenced earlier, in the intermediate
And the
period,
falling
soft
wedge.
CPI, jobs
Hit the target,
reports,
see?
still strong but moderating, JOLTS look good. So if you're data dependent, why not pause again? Why not stay on hold? Why not take another meeting off when the data was at least cutting in the direction you want to see?
So if you go back to
Nice pump now.
what we're trying to do here, we're trying to achieve a
We
stance of
want the
policy
pump.
that's sufficiently restrictive to bring inflation down to 2%.
Congratulations, you're in the money now. 29,500 to the upside, baby. Shout out to anyone that took that trade with the lifer.
The meaning of that was
We don't just go over the meeting. We give you an actual trade on the meeting. Look, shoulder, head, and shoulder to the upside.
We looked
Beautiful.
at the intermeeting data, and as I mentioned, broadly
Master
consistent.
short squeeze the 29,600 on the
consistent,
futures.
but broadly consistent with expectations, and as a result, we went ahead and took another
Volatility
step.
at its best.
And that's a labor market that continues to be strong, but gradually slowing. I mentioned that the
5
inflation
second
report was
chart,
actually a little
30 second
better
chart.
than expected, but we're going to be careful about taking too much signal from a single reading. And growth came in stronger than expected. So that's how we look at it, and so we did take that step today.
He didn't say anything. Don't worry about it.
Nick
You didn't-
Timmeros of the Wall Street Journal.
You didn't miss it.
Chair Powell, markets widely believe the median FOMC participants' inflation forecast from June for the fourth quarter of this year will be too high, given autos and shelter, and that by September that may warrant a downward revision in the inflation forecast of 20 to 30 basis points. Would that type of inflation progress be enough to hold rates steady from here, or do you need to see below-trend growth and decelerating labor income growth to be convinced that you've done enough?
So it's hard to pick the pieces apart and say, how much of this and how much of that. We'll be looking at everything. And, of course, we'll be looking to see whether the signal from June
Stochastics are high, bearish
CPI
divergence. We should
is
get a pullback here on the
replicated
30-second.
or the opposite of replicated, or whether it's somewhere in the middle. We'll be looking at the growth data. We'll be looking at the labor market data very closely, of course, and making an overall judgment about that. It's the totality of the data, I think, but with a particular focus on making progress on inflation.
If I could follow up, last month you said there were benefits to moderating the pace of increases because it would give you more information to make decisions. Would another CPI report like the one
Welcome
we just
to
had in
Crypto, we
June
love you.
allow you to at least maintain that slower pace and defer until the fall any decision on whether you need that second rate hike?
So I'm just going to tell you again what we're going to do in September. We're going to look at two
thought I
additional
told you,
job
boy. I'm gonna
reports,
tell you
two additional
again.
CPI reports, lots of activity data, and that's what we're going to look at, and we're going to make that decision then. And that decision could mean another hike in September, or it could mean that we decide to maintain at that level. And again, the question we're going to be asking ourselves is, is the overall signal one that we need to do more, that we need to tighten further? And if we get that signal whenever we get it, then, and that's the collective judgment of the committee, then we will move ahead. If we don't, then we'll have the option of maintaining policy at that level. But it's really dependent so much on the data, and we just don't have it yet.
Shout out to Muhammad. We love you too, brother. Darth Dude, we love you, brother.
Hi,
GF Burt.
Chris Rugaber at Associated Press. So consumer confidence in the economy is rising, likely in large part because of the declines in headline inflation. You also see wages are also rising faster than prices now after trailing them for a long time. How much are Americans truly harmed by inflation at its current level, headline level of 3%? And with that in mind, when do you put some weight back on the employment side of the dual mandate?
So I guess I'd say it this way. First, it is a good thing that headline inflation has come down so much, because that's really what the public experiences. And I would say that having headline inflation move down that much almost creates it will strengthen the broad sense that the public has that inflation is coming down, which will in turn, we hope, help inflation continue to move down.
Watching this flag on the 30-second chart if you're just jumping on in.
So you are really, sorry.
We got BOOKMAP on the left with liquidations.
Well, I mean, you've talked for many press conferences now about the harm created by inflation, how hard it is for people. So how much of that are we still seeing with inflation now down at 3?
So I guess I would put it this way. I'd say it this way. It's really a question of how do you balance the two risks, the risk of doing too much or doing too little. And, I would say that, we're coming to a place where there really are risks on both sides. It's hard to say exactly whether they're in balance or not, but as our stances become more restrictive and inflation moderates, we do increasingly face that risk. But
Tommy going, love you, brother.
we need to see that inflation is durably down that far.
Shout out to Cuz for real. We love you, brother.
We think, and most economists think, that core inflation is actually a better signal of where headline inflation is going, because headline inflation is affected greatly by volatile energy and food prices. So we would want core inflation to be coming down, because that's what we think core is signaling where headline's going to go in the future. And core inflation is still pretty elevated. There's reason to think it can come down now, but it's still quite elevated. And so we think we need to stay on task, and we think we're going to need to certainly hold policy at a restricted levels for some time, and we need to be prepared to raise further if we think that's appropriate.
I don't like that.
And then if inflation were to, just a quick follow, if it stays at 3 or drops even a little bit more, I mean, how much of an increase in unemployment do you think is acceptable to get that last bit of inflation? People are talking about the potential difficulty of the so-called last mile of inflation. So, but how much unemployment do you think is justified to get down that last?
So it is a very positive thing that actually the unemployment rate is the same as it was when we lifted off in March of 22 at 3.6%. So that's a real blessing, and that we've been able to achieve some disinflation. And we don't seek to, it's not that we're aiming to raise unemployment, but I would just say the historical record, we have to be honest about the historical record, which does suggest that when central banks go in and slow the economy to bring down inflation, the result tends to be some softening in labor market conditions. And so that is still the likely outcome here. And we hope that that's as little as possible. We have to be honest that is the likely outcome. The worst outcome for everyone, of course, would be not to deal with inflation now, not get it done. Whatever the short-term social costs of getting inflation under control.
What are you talking about?
The longer-term social costs of failing to do so are greater.
You already did that a long time ago, like that.
Very clear on
See, that was 50 to 100 years ago, my man.
A period where inflation expectations are not anchored, inflation is volatile, it interferes with people's lives and with economic activity.
He's describing our economy right now.
That's the thing we really need to avoid. And
oh my God, this is la la land, yo. We need to avoid what we're actually in right now.
At this point, you say the policy is restrictive, but all year long we have seen growth surprise to the upside, unemployment to the downside, and inflation lately to the downside. So I'm wondering, by definition, should you be restrictive enough right now under these conditions? Do you think you might need to do more? Because I'm curious about what you see as inflation dynamics now? Is the economy still moving in a direction where it creates more inflation? People talk about base effects and higher energy costs, and now we have some large labor settlements. Or is the economy disinflating, and you're able to go back to the old Fed policy of opportunistic disinflation?
So see this break back to the upside here on this falling
again, the
wedge.
broader picture of what we want to see
Target's 29,606.
is we want to see easing of supply
Could be a
constraints
0.82%
and
gain.
normalization of pandemic-related distortions to demand and supply. We want to see economic growth running at moderate or modest levels to help ease inflationary
That
pressures.
hidden bullish divergence
We want to see
on the
continued
32nd
restoration
chart.
of supply and demand balance, particularly in the labor market, and all of that should lead to declining inflationary pressures. Now, what we see is we see those pieces of the puzzle coming together, and we're seeing evidence of those things now. But I would say that what our eyes are telling us is that policy has not been restrictive enough for long enough to have its full desired effects. So we intend, again, to keep policy restrictive until we're confident that inflation is coming down sustainably toward our 2% target, and we're prepared to further tighten if that is appropriate. And we think the process, still probably has a long way to go.
Well, do you think under current conditions you are restrictive enough unless something changes?
Well, I think we think today's rate hike was
we
appropriate,
think.
I think we're going to be looking at the incoming data to inform our decision at the next meeting about is the incoming data telling us that we need to do more, and if it does tell us that collectively, if that's our view, then we will do more.
Colby Smooth.
Thank you. Colby Smith with the Financial Times.
Yeah, you know
If
it.
September is in fact a live meeting, how does that square with the need for a more gradual tightening pace that you spoke of last month in explaining the rationale for holding the funds rate steady at the June meeting?
So a more gradual pace doesn't go immediately to every other meeting. It could be 2 out of 3 meetings, right? It could be. It just means if you're slowing down. The point really was to slow down the decision cycle as we get closer and closer to, we think, our destination.
So funny.
And I wouldn't want to go automatically to every other meeting because I just don't think that's, I think it's not an environment where we want to provide a lot of forward guidance. There's a lot of uncertainty out there. We just want to keep moving at what we think is the right pace. And I do think it makes all the sense in the world to slow down as we now make these finally judged decisions. And so that's what we did. And so I think it's possible, I mentioned before, it's possible that we would move at consecutive meetings. We're not taking that off the table, or we might not. It's really going to depend on what the data tell us.
30 seconds should break out to 29.6.
So we shouldn't assume that every other meeting is the lowest tightening frequency, let's say. It could be, longer intervals in between as well.
I think we're going to, I think we're going to make a decision about the next meeting, and then we're going to make a decision about the one after that. And I think it'll sort itself out.
He's in a tight spot.
Thanks. Howard Schneider with Reuters. Among your colleagues, there have been people who've said they feel that very little transmission has taken place so far from monetary policy into the economy, and there are those who feel, they say, it's happened very fast this time and it's kind of up to date. Where are you on that continuum?
Exactly, Luke John. Exactly.
So there's a long-running debate about the lags between changes in financial conditions and the response to those changes from economic activity and inflation, right? So we know that in the modern era, financial conditions move in anticipation of our decisions, and that has clearly been the case in this cycle. So in a sense, the clock starts earlier than it used to, but that doesn't necessarily change the process from that point on, and it's not clear that it has. We also, I'll tell you what we know and then what we don't know. We know that financial conditions affect economic activity and inflation with a lag that can be long and variable, or lags, plural, that can be long and variable. A lot of uncertainty around the length of the lags, and by the way, that's just one component of the broader uncertainty that we face. So I'll tell you how I think about this. The first thing to say is we're determined to bring inflation down to 2% over time, and we will use our tools to do that.
He will never do
no one
it.
should doubt that.
I promise you in my life.
I would look at it
shouldn't
this
say
way,
that,
though.
but it's highly
the real
unlikely.
federal funds rate is now in meaningfully positive territory. If you take the nominal federal funds rate, subtract a mainstream estimate of near-term inflation expectations, you get a real federal funds rate that is well above most estimates of the longer-term neutral rate. So I would say monetary policy is restrictive, more so after today's decision, meaning that it is putting downward pressure on economic activity and inflation. We'll keep monetary policy restrictive until we think it's not appropriate to do so. So that's how I think about it. I mean, if I sum it up, I would say we've come a long way. We are resolutely committed to returning inflation to our 2% goal over time. Inflation has proved, repeatedly, has proved stronger than we and other forecasters have expected. And at some point that may change.
Bullish eyebrows.
We have to be ready to follow the data, and given how far we've come, we can afford to be a little patient as well as resolute as we let this unfold.
On the credit side, I'm wondering if you saw anything in the latest SLOOS data that made you think you're getting a quantum of credit contraction beyond what you'd expect. The bank lending data really is, the growth rates edging down towards and below, heading below zero, which is usually a recession indicator.
So I guess the SLOOS will come out early next
We've
week.
come a long way, Dan.
And I would just say it's broadly in consistent with what you would expect. You've got lending conditions tight and getting a little tighter. You've got weak demand, and it gives a picture of pretty tight credit conditions in the economy. I think it's really hard to tease out how much of that is from this source or that source, but I think what matters is the overall picture is of tight and tightening lending conditions, and that's what this SLOOS will say.
The SLOOS. Who are those?
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks
Rachel.
for taking our questions. Could you break down the reasons why inflation has fallen and what share of that credit you would give to factors that don't stem directly from rate hikes or that might be within your control at all, like easing supply chains and a drop in energy prices over the past year?
Yeah. So
symmetrical
interesting
triangle,
question.
possible
So
shoulder, head, and shoulder
let me
here.
start by saying
on the
that
30
the
sec-
inflation
on the 30
surge
second
that we
chart.
saw
Sorry.
in the pandemic resulted from a collision of elevated demand and constrained supply, both of which followed from the unprecedented features of the pandemic and the response from fiscal and monetary policy. And we've always expected that the disinflationary process would stem from both from the normalization of those broad pandemic-related supply and demand conditions and from restrictive monetary policy, which would help return the balance between supply and demand by restraining demand. And we think that's broadly what we're seeing. So to go break it down a little further, of course, headline inflation has come down sharply from elevated levels as energy and food prices have come down, mostly due to reversal of the effects from the war in Ukraine. And that's a good thing, and the public experiences that, as I mentioned
Gas
earlier.
has been going up for me, too.
For core inflation, I'd say there has been a role for both factors, both that I mentioned. Clearly, for goods, normalization of supply conditions is playing an important role.
What a nice guy over there.
The reversal,
Give that guy
the
a
beginning
steak.
of the reversal of spending back into services and away from goods. And take autos as an example. The combination of an increase in sales and inventories, while vehicle inflation has decelerated, points to a substantial role for supply. But there's also a role for demand, as the loans and things like that are more expensive. So they're both working there. Housing services inflation now starts to move down. Clearly, higher rates have slowed the housing market. I would say monetary policy is working about as we expect, and we think it'll play an important role going forward, in particular in non-housing services, where really we think that's where the
You see her
labor
looking at him
market,
like he hasn't answered
will
any.
come
She's
in
like,
as a very
when did
very
he
important
answer
factor. So we
anything I
think
said?
both of those
like, I'm so confused.
sources of disinflation
But
are
it
playing an
looked
important role.
interesting,
See, and just to follow up, do you think that of those two sources, that core will rely more heavily on seeing an impact from rate hikes, or is there a more even split there too?
I think monetary policy is going to be important going forward, because we're sort of reaping now the benefits of the reversal of some of the very specific pandemic things. We're seeing that with goods in particular, with supply chains and shortages moving, and we're seeing. So I think going forward, monetary policy will be important, particularly in the sector, in the non-housing services sector.
Edward.
Thank you, Chair Powell. First, let me compliment your tie, the choice of tie. So thanks for taking our question. So the Beige Book, it said input cost pressures remain elevated for services firms, but eased notably for manufacturing sector. Is that an indication that there's a wage inflation pressure? And how do you target and pressure on the wage inflation without pushing the economy into recession?
I think as it relates to goods, it's really an indication that supply chains and shortages are easing. And so what was the first part of it?
So wage inflation, like how do you target wage inflation without pushing an economy into a recession?
I don't think we're targeting wage inflation. I think what we're looking for is a broad cooling in labor market conditions, and that's what we're seeing. So wages have actually been gradually moving down. They're still at levels that would be consistent over a long period of time with 2% inflation. Nonetheless, we're making progress there. And by so many indicators, labor market demand is cooling. You can look at surveys by workers and businesses who see that. You can look at the quits rate normalizing. You can look at job openings coming down. You can look at just job creation in the establishment survey has, it's still at a high level, but it was at really an extraordinarily high level for most of the last 2 years. So you see cooling, particularly in private sector in the last, in the last report. So I think we see that, and it's happening at a gradual pace. So that's actually not a bad thing in a sense, because if what we see is a labor market, very strong demand for labor, which is really the engine of the economy. People are getting hired, many people going back to work, getting wages, spending money, and that's really what's driving the economy. But that's gradually slowing. It's gradually cooling. That's a good prescription for getting where we want to get.
But still, we see a push to raise minimum wage. We're seeing a lot of unions go on strike or threaten strike. And the common thing is they come out with agreements like big pay increases, like UPS, and we have the auto workers coming up. Are you concerned then about a trend of series of big unions, these contract pushing wage inflation then?
Not for us to comment on contract negotiations. Not our job, not our role. We monitor these things and we'll keep an eye on them. But really, that's something that's handled at that level. And
at that level, he's so good at saying whatever and just letting it go. Like what level? Like
Hi,
what?
Victoria
Like what the
Guido,
heck was he
Politico.
talking about? He can say whatever he wants. He's
I wanted
awesome.
to ask about the SEP, which suggests that you would cut rates as overall and core PCE get to around or under 3%. And so I'm wondering, is the level of inflation what's sort of important there as you think about getting to 2% and when you might start cutting rates, or is the speed at which inflation is falling also important?
I think you'd take both into account. I think you'd take everything into account when you start cutting rates. It would depend on a wide range of things. And when people are writing down rate cuts next year,
it's kind of symmetrical. It could go either way here.
It just is a sense that inflation is coming down and we're comfortable that it's coming down and it's time to start cutting rates. I think, but I mean, there's a lot of uncertainty between what happens, in the next meeting cycle, let alone the next year, let alone the year after that. So it's hard to say exactly what happens there, what's motivating people.
So if it's sort of stubbornly in maybe the high 2s, you wouldn't necessarily cut rates.
I'm not saying that at all. I'm not giving you any numerical guidance around that. I'm saying we'd be comfortable cutting rates when we're comfortable cutting rates, and that won't be this year, I don't think. It would be, many people wrote down rate cuts for next year. I think the median was several for next year, and that's just going to be a judgment that we have to make then, a full year from now, and it'll be about how confident we are that inflation is in fact coming down to our 2% goal.
A good part of Wall Street has become more confident that the Fed is going to be able to engineer a soft landing, and they've reduced their forecast for a recession. And I'm wondering if the staff has changed its view on the likelihood of a recession being likely, and if you personally have changed your view in terms of becoming more confident that you can achieve a soft landing.
So
he's not going to want to talk about soft landings because he's going to act like he can't handle it. So it's not.
We do have a shot, and my base case is that we will be able to achieve inflation moving back down to our target without the kind of really significant downturn that results in high levels of job losses that we've seen in some past instances, many past instances of tightening that look like ours. That's been my view. That's still my view.
Starting to dump here.
And I think that's sort of consistent with what I see today. So, but it's a long way from assured, and we have a lot left to go to see that happen. So the staff now has a noticeable slowdown in growth starting later this year in the forecast, but given the resilience of the economy recently, they are no longer forecasting a recession. I just want to note that that our staff produces its own forecast, which is independent of the forecast that we, as FOMC participants, produce. Having an independent staff forecast, as well as the individual participant forecast, is really a strength of our process. There's just a lot of, I think, constructive diversity of opinion that,
nice
that
to hear,
helps us
Jerome.
make.
So happy.
Informs
Thanks
our
for letting us
deliberations,
know.
helps us make.
Amazing. You guys
I
are
hope
great.
better decisions.
Love that.
And is the reason for optimism that inflation has come down and you still have a strong labor market? I mean, does that add to the optimism?
I wouldn't use the term optimism about this yet. I would say, though, that there's a pathway.
Chill.
And yes, that's
chill,
that's,
Jerome.
that's
Chill.
a good
Don't be
way to
saying
think
stuff
about
like
it.
that.
We've seen so far
Stay optimistic.
the beginnings of disinflation without any real costs in the labor market, and that's a really good thing. I would just also say the historical records suggest that there's very likely to be some softening in labor market conditions. And consistent with having a soft landing, you would have some softening in labor market conditions, and that's still likely as we go forward with this process. But it's a good thing to date that we haven't really seen that. We've seen softening through not through unemployment, not through higher unemployment. We've seen softening through job openings coming down part of the way back to more normal levels. The quits rate, so people are not quitting as much.
The
We've
quits
seen
rate.
participation, people coming in, and so labor supply has improved, which has lowered the temperature in the labor market, which was quite overheated, going back a year or so. So we're seeing that kind of cooling, and that's very healthy, and we hope it continues.
Jeff.
Thank you, Mr. Chairman. Jeff Cox from CNBC.com. You and other Fed officials in the past have suggested that you don't need to keep hiking until inflation hits 2%, that as long as you see continued progress. So I'm wondering, how close do you need to get with the inflation numbers coming down? How many months of data
We don't know.
do you need to see that will give you sufficient
We'll take
confidence?
it one day at a time.
And how far does this fight need to go before you're willing to kind of declare victory on it?
So the idea that we would keep hiking until inflation gets to 2%, it would be a prescription of going way past the target. That's clearly not the appropriate way to think about it. So.
So how do you know? If you don't know what you did today
we
and how it affects
the
the next
median
3 months, then how do you know when to
participant,
stop?
again, these are forecasting out years, so take them with a grain of salt. But people are cutting rates next year because the federal funds rate is at a restrictive level now. So if we see inflation coming down credibly, sustainably, then we don't need to be at a restrictive level anymore. We can move back to a neutral level, and then below a neutral level at a certain point. I think we of course would be very careful about that. We'd really want to be sure that inflation is coming down in a sustainable level. And it's hard to make, I'm not going to try to make a numerical assessment of when and where that would be, but that's the way I would think about it, is you'd stop raising long before you got to 2% inflation, and you'd start cutting before you got to 2% inflation too, because we don't see ourselves getting to 2% inflation until, all the way back to 2 until 2025 or so. So
You're never getting to 2%. Oh, that just dumped the markets, man. Oh, God.
Thank you, Chair Powell.
It's kind of an Adam and Eve double
Yahoo
top
Finance.
there. See that? Shoulder,
it's been
head,
over
shoulder.
4 months since a handful
missed
of
that.
regional banks,
Look,
including
shoulder,
Silicon
head,
Valley
shoulder,
Bank,
dump.
failed.
See
When
that?
you look at credit conditions now, given Bank of California's
Adam and Eve
acquisition
vibe to
of
it.
PacWest, does this acquisition suggest the full
Dumpish.
impact has not been felt, or are you comfortable saying that
Also was
we've
like a
seen
descending
most
triangle.
of the ripple effects that may have occurred at this point, and how does this play into your outlook for policy?
Ooh, we got
So
pounded.
I don't want to comment on any particular merger proposal, but I will
Massive
say,
short squeeze.
things
long
have settled
squeeze.
down for sure out
Long's
there.
getting pounded.
Deposit flows have stabilized. Capital
I don't trade
liquidity
these
remains
days. Be
strong.
careful, man.
Aggregate bank lending was
How
stable
many people just got
quarter-over-quarter
liquidated,
and
thought
is
they
up
were on
significantly
point?
year over year. Banking sector profits generally are coming in strong this quarter, and overall the banking system remains strong and resilient. Of course, we're still watching the situation carefully and monitoring conditions in the banking sector. In terms of the the actual effect on, if you think of a particular set of banks that were affected because of their size and business model and things like that, that were more affected by the turmoil in March than others, it's very hard, as I mentioned, it's very hard to sort of tease out the effects on this very large economy of ours from them tightening. They may be tightening a little bit more, probably are, than other banks. The SLOOS has been telling us for more than a year that banking conditions are tightening. That process is ongoing, and that will restrain economic growth. So I think we have to take a step back from. I can't separate those anymore. I think basically we're just looking at the overall picture, which is one of tightening credit conditions, and that's going to restrain economic activity. It is restraining economic activity. So that's how I would look at it.
And how is that informing your outlook for setting policy?
So I think that is an expected result of tightening interest rate policy, is that bank lending conditions would tighten as well. And so the question is it more effective this time because of what happened in May? I just don't think we know that. I think we're looking at the current data in GDP, and we're seeing strong spending, we're seeing a strong economy, and it's made us confident that we can go ahead and raise interest rates now for the third time since the March events. It seems like the economy is weathering this well, but of course we're watching it carefully and expect to continue to do that.
Hi, Chair Powell. Thanks for taking our questions. Megan Casella with Barron's. I wondered on wages if you were at all concerned about any inflationary impact of wages now outpacing inflation, which is likely contributing to the boost in consumer sentiment and the continued strength of the consumer that we've been seeing.
Well, wages in excess of inflation means real wages are positive. Again, that's a great thing. Of course, we want that. We want people to have real wages, but we want wages to be going up at a level that's consistent with 2% inflation over time. As I mentioned, nominal wages have been coming down gradually, and that's what we want to see. We expect to see more of that. That's just more of what's consistent over a longer period of time. We don't really think that wages were an important cause of inflation in the first year or so of the outbreak, but I would say that wages are probably an important issue going forward. Labor market conditions broadly are going to be an important part of getting inflation back down, and that's why we think we need some further softening in labor market conditions.
This goes sort of to the balance of risks question, but you mentioned at the start how you're keeping an eye on consumer activity and whether there might be some sort of a rebound there. And I'm curious what the Fed's explanation would be to families if further interest rate hikes start to hit the labor market, start to drive that sentiment back down. What's the message there of why you continue to keep rates elevated or to raise them?
Well,
we got to crush you like a bug.
Assigned to us by Congress to get inflation under control, and we think the single most important thing we can do to benefit those very families, especially families at the lower end of the income spectrum, is to get inflation sustainably under control and restore price stability. We think that is the most important thing we can do now, and we're determined to do that. And I would just point out that the people who are the most hurt by inflation right away are people who are on a low fixed income, who, when you're talking about travel or transportation costs, heating costs, clothing, food, things like that, those, if you're just making it through each month on your paycheck and prices go up, you're in trouble right away. Even middle class people have some resources and can absorb inflation. People in the lower end of the income spectrum have a harder time doing that. So we need to get this done, and the record is clear that if we
need them to lose more jobs,
take too long, or if we don't succeed, that
I get
the pain
it, but
will
it's
only
still
be greater.
I don't
So
get it. It's like
that's how I would explain what we're doing.
So we need to crush those people there, make sure they lose more jobs.
Thank you, Chair Powell. Simon Urbanovich with The Economist. You had said last month that this meeting this week was going to be a live one. In the event the market had assigned a roughly 99% probability to the rate move that you announced today, the decision was, of course, unanimous. And the statement was basically unchanged from last month. So may I ask, to what extent was the meeting actually a live one? Was there ever any doubt over the past 2 days about what the decision was actually going to be?
Well, I mean, Was there doubt? Look, I would say there's a range of views on the committee, and when you see the minutes in 3 weeks, you'll see that. There's a range of views about what we should do at this meeting and what we should do at the next meeting, and it's a process that we go through. Many times when we go into a meeting, the decision is not, fundamentally in doubt. Nonetheless, we have the meeting, and some
broadening, falling
meetings
wedge, in case you didn't know.
Less uncertain than others, and I'll just leave it at that.
They do break up to the upside 60% of the time. He said it's none of your business. Why don't you F off?
Financial conditions have been loosening at a fairly steady clip in recent weeks. The dollar, the stock market, et cetera. What does that mean for the Fed and being sure that inflation will come down to target?
So we monitor, of course, financial conditions, broad financial conditions. You're right, it's the dollar and equities, and we're of course very focused on rates and our own policy. We're going to use our policy tools to working through financial conditions to get inflation under control. The implication is, we will do what it takes to get inflation down, and in principle, that could mean that if financial conditions get looser, we have to do more. But what tends to happen, though, is financial conditions get in and out of alignment with what we're doing, and ultimately over time, we get where we need to go.
Here, I'm playing with.
If I could also ask about the SEP from June that showed rate cuts. Do you expect the Fed to cut nominal rates next year while also continuing QT?
So that could happen. The question is, is that consistent with? So if you think about both of them as normalization, imagine it's a world where things are okay, and it's time to bring rates down from what are restrictive levels to more normal levels. Normalization in the case of the balance sheet would be to reduce QT, so or to continue it, you depending on where you are in the cycle. So they're two independent things, and really the active tool of monetary policy is rates, but you can imagine circumstances in which it would be appropriate to have them working in what might be seen to be just different ways, but that wouldn't be the case.
Let's go to Kyle.
Thanks, Chair Powell. Kyle Campbell with American Banker. I have a question about the discount window. I'm wondering if since the bank failures of the spring, if you've seen signs that banks have taken more steps to be proactive in assuring that they're ready to use that facility if they need to. And if you have any sort of thoughts on whether policies might be appropriate for making sure that banks sort of test regularly to show that they are prepared to use it. Thanks.
So that's a very important thing, yes, and yes to both sides of that. Yes, banks are now
so
working to see that they are ready to use the discount window, and we are strongly encouraging them to do that, banks broadly. We did find, as you know, during the events of March, and that that it's a little clunkier. It can be a little clunkier and not as quick as it needs to be sometimes. So why not be in a situation where you're just much more ready in case you need to access the discount window?
Because you're going to bail out.
Let's go to Mark.
Because no one wants to tell anyone that they're about to bail out yet. So they're not going to tell anyone they're going to use the discount window. It's going to create a withdrawal frenzy,
man. The housing market back into better balance, excuse me, and also that the market might have bottomed. Where do you see that situation and balance, or lack thereof, right now, particularly with the constrained inventory of existing homes that might otherwise be coming onto market at a time when existing homeowners are reluctant to move? And of course, all of that happening with the 30-year fixed-rate mortgage still around 7% on the heels of Fed tightening, and with what you're talking about, tightening industry lending standards. Are we getting closer to balance or farther away? What's your sense?
I think we've got a ways to go to get back to balance, really for the reasons that you talked about. With existing homes, there are many people who have low-rate mortgages, and whereas they might want to sell in a normal situation, they're not going to because they have so much value in their mortgage, which means that supply of existing homes is really, really tight, which is keeping prices up. On the other hand, there's a lot of supply coming online now, and there are people coming in. A lot of the buyers are first-time buyers coming in at buying it with these relatively elevated mortgage rates. But I think this will take some time to work through. Hopefully more supply comes online, and we work through it. We're still living through the aftermath of the pandemic.
We'll go to Nancy for the last question.
That's it.
Hi, Chair Powell.
Some
Nancy
extra people today.
Marshall-Genzer with Marketplace. Russia has pulled out of an agreement allowing shipments of grain, safe passage through the Black Sea, and alternative routes at this point could be closed off. Just wondering, how could that contribute to higher food prices and inflation generally, and how closely are you watching that?
We are watching it, of course, very closely. And you're right, the withdrawal from the Black Sea Grain Initiative does raise concerns about global food security, particularly for poorer countries that import a large share of their food. Grain prices did go up on this news, but they remain well below their peaks of last spring. And the moves that we've seen so far, I would say, are not expected to make a significant contribution to U.S. inflation. Of course, we will be watching that situation carefully.
So you don't think it would have a big effect on Fed policy at this point?
You wouldn't say so looking at what we know now.
Thank you.
Thanks very much.
That's it. That's it. That's it. That's it. Thank you so much for coming on in. We're going to hang out for about 5 to 10 minutes more. But that was it. I mean, thank you so much for being here with me. That was unbelievable. We're going to talk about Bitcoin, kind of show you what's happening with the chart now and break it down. We'll start fresh with a brand new chart, and we'll just look at everything and see what happened. But kind of where we went, where we are going, and where we could be headed. So, Sweetie Pie, how's it going? I love you. I'm almost done, okay, Sweetie Pie? All right, baby. Daddy's a streamer. He's always in front of that computer, that daddy. So let's take a look here. Let's bring the music back on. Let's get a little stream going. Let's get back to life, back to reality. Get it? Oh, come on. Back to life, back to reality. I grew up in 1983. Hey, don't blame me for that. Let's take a look here. At Bitty Bitcoin, getting resistance at 31,800. Okay. Bouncing here off of 25,005. 25,001, actually 200. We know that already, but we've gone over this 100 times. I'm just breaking it down yet again. All right. And we just see our key levels on the weekly of support and resistance. And that level right there, 30,300, we would love to break back above. Let's go to our 3-day chart. I do this like 7 times a day sometimes, but I don't mind. I put in that effort every single time. So previous resistance on the daily, on the 3-day chart, is breaking as support here. Previous resistance on the daily, so it is kind of supportive resistance on the daily. You're kind of in it. You're on it. You know? You'd say right there is really your next hardcore level, though. Resistance, bounce, resistance. Okay? And then I had it, you know, you can almost say, hey, we're in a falling wedge that broke out once. Broke back inside, still inside the wedge. Nice little flag that could break to the upside, back to the top of the channel too as well. All right. I've also on the idea of the bullish megaphone that broke to the downside. Both are valid. Like, that's what people don't realize. Both of these ideas can be valid at the same time, you know? So, but this is, can we get back inside the bullish megaphone and turn this into a bearish trap? Where they trapped all the bears, got a bunch of stop losses right here, and they're ready to rip the price back to the upside. All right, so that's kind of where we stand. Very oversold on the daily time frame. Very oversold on the 22-hour. Not the best place to short a market, in my humble opinion. Okay, 4-hour, however. All right, I know what I just said. You're like, but he just said, hey, but listen, it's one step at a time. The 4-hour, however, is in a bear flag. That's a bearish flag. Hands down. And today we solidified that we were kind of even more in a bearish flag. The length of that pole is your measured move. Takes you right back down to 28,500. All right. That 28.5 level has been a talk for a while now. So here's the deal. You open up a short with a stop loss on the other side of the bullish megaphone right here and see what happens. Possibility. There's an idea right there. Close though. Stop loss is almost outside of my range. At 2.7, I like that to be a 3, so it's a little high risk of a trade. All right. But that 4-hour does suggest that that could happen. What could stop that from happening? You know? Well, the 1 hour has been just slowly moving up. You can take from here to here, uptrend, uptrend. No crazy bearish div. Nothing crazy yet. So that's still okay. And this idea is still kind of in the picture. Did we retest that area there off of the top trend, you know? Like right there, that is the resistance that I want to stay back above. So I'm watching this flag here on the 1 hour time frame. It's a bit overbought though. And I wouldn't be surprised if we came down and tested the bottom of the pattern here like this one more time and reset on the stochastics RSI. All right. Now, if we come in bearishly retest, I'd be shorting on the smaller time frames. Okay. But right now, we got consolidation sideways. Usually, we consolidate a little more after a rate hike. The market kind of sits in kind of a state of just like, all right, that's what we got. Some people didn't get what they want. They walk away. A lot of people walk away right now. They just walk away from the market for a little bit. They either got their, hey, we put out a call on the live stream during the rate hike. We put out that inverted head and shoulder, that hit for gains, in and out, call it a day, bang, right? We showed you the target. We showed you the entry, stop loss below that, the right shoulder of the inverted, and bang, 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 that thing played out. So we showed you a live trade here on the channel that played out nicely, or a live setup. We showed you technical analysis that we didn't actually open up a trade on an exchange. So, you know, I don't want to be facetious there, but we did show you a trade price action wise that could have been tangled or nailed or whatever you want to call it, right? So this is more bearish than bullish in my humble opinion, all right? And I got some mixed signals with both these patterns, kind of top, a resistance pattern here too, you know? So either both of these are basically got the same, it doesn't really matter because they got the same measured move, you know, to the downside. So Bitcoin, we're going to watch the smaller, yeah, so we want to watch these smaller time frames, the 15-minute, the 1 hour. And honestly, like price action has to get above that wick now. I don't know what just happened. I just somehow like deleted price action, which I don't know how I did it, but it did. When you do a lot of live streaming, eventually your finger will slip and you will see something you didn't realize. You know what I mean? Shout out to the 545 people on the live. God bless each and every one of you still here after the rate hike. You're awesome people. Good for you. God bless you all for staying with me. I have a very crazy work ethic. Like my live streaming today, my stamina, it's crazy. I'm like, Sam, man, take the tie off. I also have to do an interview later on today at 2 as well at about 4:45, so it does not stop. Then we live stream that interview tonight at 7. Got to make sure the team does everything right. We got to make sure the edit goes well. And we got to keep going in the charts. We got to keep up with the Bitcoin update at 8 p.m. at the daily candle close. I got to look for the hottest coins that come out tomorrow. It does not stop. I'm telling you right now, tireless work, but I wouldn't want it any other way. So thank you everyone for being here with me. I really appreciate it on this beautiful, beautiful Wednesday, July 26th. And you know what's awesome? I think we can celebrate today, and I'll tell you why. The next rate hike is in 55 days, the next meeting. We have a month off. You know, we had one in June, we had one in July. Now we don't have to deal with this until September. It's kind of nice, don't you get it? We get August off. Like August 26th next month, we're not going to have to do this. That's bullish in and of itself. You know what I mean? Because the markets react to this kind of like, it's bullish in and of itself that we won't have to deal with another rate hike until September. So we made it through a rough time of constant meetings. You know what I mean? So that alone to me is like, it's like you have to go to the principal's office every month, but like next month we don't got to go to the principal's office. You know, like you take a break, you know, and usually it lets the markets breathe a little bit, gives them a little space. Look at all this interaction. Look at all this volatility that happens from these Fed meetings. Look at that. Look at all this insanity. All the liquidation, because there's just so many people kind of attempting to take advantage of the situation. And, you know, they heard a story of their buddy hitting a huge gain the last time it happened, and so they think they're going to do it too. Or they open a long and a short. They get liquidated on both sides. You know, they're not as good as Jason Casper. Jason knows exactly what he's doing. If you're not going to do it every single day and put all your effort into it, you're going to get smashed, man. Smashed like Smashburger, baby. You know? Shout out to Justin Cashmore in the house. Shout out to David Roy. Shout out to Bert Mandrew, GF Burke, Apex, BTM, Crypto, Diano, Pit Stop Moto Racing Team, my man. We love you. And Jay Bella in the house. David Roy in the house. So what do I see happening for Bitcoin? I see us going sideways, honestly. And the 1 hour says it wants to make a dump. So I'd look for downward price action right now. Or, you know, honestly, it just makes more sense when I put this in this channel like so. Just makes far more sense. I don't want to lose both perspectives, though. I want to be open-minded. But I see a move back to at least back here down to the bottom of the pattern for the next few hours. And the 1 hour resets. If we can stay there, then there's a chance we could V-shape recovery. We still have that beautiful divergence here. That was on the 7 minute. Hard to see here, but was on the 7 minute time frame. And we did call that bottom on Monday. We do have a gap in the VRVP that's working in our favor. We did hit the value area lows on the wick, which tells us we could definitely get back up to the point of control. So that's some bullish signs here. So we just kind of make sure market structure kind of stays intact. You know, it would be cool if we make some type of symmetrical triangle here on the 1 hour time frame and then break to the upside. So I'd look for this to reset. Anything could happen. We could pump all the way up to the 200 SMA right here, but I'd look for this to reset, do some consolidation, and we just have to make sure we don't go below 29,118 like that. See, resistance. We got to make sure we're SR, because previous resistance became a support as we bounce. We want to SR flip that zone and make sure that we're consistently, and then we got to make another higher high. Eventually, we got to get above this high here at 30,340, but we'll talk about that when the time comes. For now, reset, some type of consolidation on the 1 hour, and I'll give you guys your update tonight around 8 o'clock, about 5 hours from now, 4.5 hours really from now, not too long ago. So that's what I'm looking at for Bitcoin. If the 1 hour decides to drop us and we lose this trend line, I'd look for a bearish retest or a bear flag on the 5 minute, the 1 minute, even the one, and I would consider a short back down to 28,500. So short is on the table. It's probable, but the smaller time frames will give us the confirmation of the move. Everyone, thank you so much for being here. Please comment, like, and subscribe. Hit the bell for notifications. You can find out when I post my next video. Remember, if you came to the channel, then you're already doing the right thing. Shout out to my man Tex Crypto for becoming an exclusive member. Shout out to Jason Casper for the $99 super chat. People have been blessing me the last few days. It's been insane. Crypto Billy with the 5, then the 3, then this one, then yesterday, then the $250 this morning. You people are some of the nicest people I've ever met. Thank you so much for the love and for the respect. I greatly appreciate it. I'll see you all tomorrow on another beautiful live stream. And look out tonight as I interview Mark Whitfield. Very, very interesting guy. Dude is amazing. I'm telling you right now, I went over who he was on my live stream earlier. Might as well kind of talk about it again, though. CRYPTONIZE is his channel, okay?
Here are 5 reasons.
Oh, wait. Hold on. I'm going to find the right one here. But the dude's amazing. You know, he's been involved in basically e-commerce in the Web3 space for a long time. He's just very interested, involved in cryptocurrency and honestly like e-commerce and where we're moving. You know, and we need people like that to kind of really see what's going on. So, so it's really cool. I just wanted to see, yeah. So his name is Mark Fiddleman. Yeah. But dude's super interesting. CRYPTONIZed, all right? CRYPTONIZed is his channel. Check him out, subscribe. I'm going to be interviewing him tonight on the channel, so get ready for that. Dude's super interesting, you know. Meet Mark Fiddleman, the tech-savvy founder of Smart Blocks Agency, the former chief revenue officer for the NFT leader Wax.io. Pretty cool. And also, he's been making waves in the world of crypto and e-commerce for over 2 decades. Currently, Mark writes Tokenized Insider, the go-to source for more than 5,000 forward-thinking investors and potential issuers to learn about the latest insights and industry trends and investments analysis in the world of tokenized real estate and equity capital investments. He also is a contributor to Seeking Alpha, the host of the CRYPTONIZE on YouTube, which is pretty cool. That's not all. He has been recognized as a top influencer by Forbes magazine, dude. Named a social media keynote speaker by Inc. magazine and ranked among the Huffington Post top 50 most social CEOs. Previously, Mark wrote for Forbes and interviewed hundreds of CXOs from global 3,000 companies. His expertise and experience makes him a sought-after super speaker and writer. And you can keep up with his latest insights and follow him on Twitter at Mark Fiddleman. And so I'm super excited. It's going to be one of the biggest interviews we've had. He's interesting and amazing. I'd highly advise you come on to that interview. We're going to break it down. He is going to talk more than me, and we're going to have a blast. So I can't wait to see you all there if you jump on in tonight at 7:30. Everyone, thank you so much for being here. All the links do help me. ITrust Capital. Jump on in today. Only IRA that basically lets you trade your crypto tax-free. It's amazing. Jumping into ITrust Capital today. You will absolutely love the experience. Great team, great company, great product. Unbelievable. Join the trading group. Join MEXC. TradingView, Brave. Get yourself a NordVPN. The list goes on. We have so much stuff that we affiliate with that I think are really great. So BOOKMAP, get yourself a BOOKMAP subscription today. We had a lot of fun watching the liquidations. That's always a blast. I have a blast during the Fed meetings. Everyone, thank you so much for being here. Please comment, like, and subscribe. Hit the bell for notifications so you can find out when I post my next video. Remember, if you came to the channel, then you're already doing the right thing. Let's have some lemon water. And I'm going to go be a dad with this kid. Yes, what's going on? What's going on? Come here, baby. Come here.